The Rebel Capitalist Show. Do you think the Fed put has expired? Now I'm talking just about the stock market.
I think it has. I don't think it's expired in the long run. I think tactically, when you look at what the Fed has said in the last, call it 4 weeks, in terms of wanting, Powell said something about wanting markets to price risk appropriately. I think they would love to see some of the froth taken out of the markets. I think they are probably a bit concerned that they're breaking markets, which they are. They should be, because they are.
I remember going back to middle of March. Remember the Fed was supposed to meet on a Wednesday, and that emergency meeting on a Sunday where they dropped the interest rate by 100 basis points.
Yep.
And the market just blew it off. It went up for like 3 hours and completely tanked.
Yep.
Was down by 1,000 points, whatever. And if my memory serves me right, the market really didn't start to go back up until the government came in and said, okay, we're going to do a fiscal stimulus package. So what I'm referring to is maybe the market back then, and I know Townsend's talked about this a lot. I got to give him the credit, where the Fed put in the mind of the market has expired, but it's been replaced by a government or a fiscal put, in which case that would be far more inflationary, because when the government spends the money, it directly increases M2 money supply, or if the Fed increases the bank reserves, it doesn't necessarily directly increase M2.
I see what you're saying. Yeah, I think the market is coming to the realization that MMT was basically begun 3 months ago, which is
right,
that fiscal put is there, and that the Fed put will be there to keep rates at politically expedient levels. And whatever that means, the Fed has to buy. I think when you look at the charts, it looks like some sort of yield curve control has effectively been put in place, even though they say they're still evaluating it. It looks like there is some sort of like it's already effectively in place. And I think the market's also looking through the inevitability that you sort of know what the U.S. government can afford in terms of interest rates relative to the rest of the budget before things start to spiral. And you understand that with the dollar where it is, foreign demand is not where it needs to be for treasuries, and you solve for X, and X is the Fed, and whatever X needs to be is what the Fed will do. And I think that's what we're seeing in markets to a certain degree, in terms of what the Fed's doing. And I think what the Fed did on the corporate side 2 weeks ago or 3 weeks ago, whenever that was, which seemed pretty preemptive in terms of seemingly increasing what they were doing. I think that caught a lot of people by surprise, myself included, that, boy, I thought that they would have to, after they had said we want markets to price risk, as long as markets decide to price risk where we think risk should be. Okay.
Like zero.
Yeah. Right. So you go, okay. And I think that's a little bit of where the market is right now, is it's almost like it's testing the Fed, is to say, okay, go ahead, raise rates, go ahead, really pull back we dare you, because they've got one. To me, they're not out of bullets on the downside, as we saw. Everyone said they were going into this, they were down, they were out of bullets. And I said, they're not out of bullets. They can grow the balance sheet to infinity if they want. They're not going to grow the balance sheet to infinity. Well, they grew it at a $34 trillion annual rate for a month and a half. And that was 34 trillion is pretty close to infinity.
I think Buzz Lightyear would agree, Luke.
Yeah, you don't believe me? Start counting. Let me know when you get there, right?
Yeah, exactly. All right. I wanted to touch base just briefly on the swap lines. I did a video on that the other day, and it seems very difficult for the foreign banks to get the liquidity. Let's just say that the private sector needs it in Japan. And I just kind of did some research on how the swap lines are actually set up. But let's use the BOJ as an example, that they have an account with the Fed, and the Fed just credits their account. The BOJ does the same thing at the Fed, but then the Japanese bank in this case would have to access that credit line through an intermediary in the United States, and then they'd use that to for balance sheet capacity, dollar balance sheet capacity, to lend to XYZ Japanese corporate. but they're still on the hook, and the BOJ is still on the hook if the corporate goes bust. So if there's not a liquidity issue, if there's an insolvency issue from the standpoint of that corporation just isn't getting the dollar cash flow they need, then the way I saw it, the banks won't lend to them regardless if there's dollar need or not. And the central bank might not, because they're on the hook with the Fed, because that's technically a loan that they have to play back. So I'm making a short story long here, but then I tried to think through, okay, well, how does the Fed, if they want the dollar to go down a bit, how would the Fed get the money into the hands of the people that need it? Or would they, and I know on the Fed's website, they said that maybe, my memory serves me right, like 3 or 4 times in the last 20 years, the New York Fed, the trading desk, has used dollars, sold them into the market to buy foreign currencies just to manipulate it a bit. I think the last time they did that was with the yen in the late 90s or maybe early 2000s. So I was thinking, okay, does the Fed print up the dollars so they're, you got more bank reserves there, more liabilities, and then they're using those to buy FX, or they're buying foreign currencies. That goes on to the asset side. That's what they're doing to lower the dollar. But then I thought, well, if the dollar goes too low and it gets out of control, then the Fed really, other than what they just buy, they have almost no FX reserves. So I guess the two-part question is, number one, how do you see that transfer mechanism? If you're in charge of the Fed or the trading desk and you've got to lower the dollar, the DXY, how do you do it? And then if it goes too low, then how do you prop it up if you don't have the FX reserves and you can't raise interest rates because it'll crush the economy?
Yeah, so it's a great question. I think, to me, when I think through how they could do it, I think the speech that Ben Bernanke gave back in November of 2002, it was on November 21st, I think, 2002, famous speech, deflation, making sure it doesn't happen here. It was, and no one knew it at the time, but it ended up being a really great roadmap for everything the Fed would do in the '08 crisis. And a number of people have laid that out. And it's interesting to me how few commentators read all the way through. And I think they all read all the way through, but they just don't get to these last 2 parts that Bernanke said, which is that historically the dollar has been the purview of Treasury, that historically the Fed does monetary and the dollar policy is set by Treasury, not the Fed. And he said, with that said, moves to weaken the dollar are nowhere on the horizon. But if we wanted to, here's what we could do. And the first thing he said is we could go out, we could buy foreign sovereign debt, print dollars, buy foreign sovereign debt. And so that's the first answer to the question, I would say. Okay. And I don't think that needs a change or a change of the charter. And I think that's ultimately not that different from what you were just describing before of what's on the New York Fed's website in terms of what they did. And it's basically a currency intervention. And I think that would need to come from Treasury. Hey, Fed, print up money. We want the dollar lower, get it there. And so you could do that. The other thing Bernanke talks about is devaluing the dollar against gold, as happened during the 30s. Now, it's a bit of an apples and oranges situation, because obviously gold, we were on a gold standard then, and so it was a devaluation against gold at a time when it was on a gold standard. But I think the Fed could also do that. If you look at the New York Fed's website, the Exchange Stabilization Fund, they have a wide mandate to make markets function, and foreign currencies, bonds, and gold. It says specifically, and gold. And so if the Fed really wanted the dollar down, they could come out and say, hey, gold is now 3,000, 3,100 offered, 3,000 bid. If we woke up on a Monday or came in on a Sunday night and gold was 3,100 bid by the Fed, 3,000 bid by the Fed, the dollar's probably down that next day.
Doesn't that create a feedback loop, though? If you're holding dollars as a foreigner, you want to get rid of them. It's a hot potato, and then it just keeps going down. And then how does the Fed prop it back up? I mean, let's just say the DXY drops to 60 or whatever the Fed would consider too low to where it's not good. Then how do they prop it back up?
You can probably do it just by selling what they bought, I guess, right? In terms of some of those assets. If they had enough of them, you could start selling gold into the market at that point, or lowering the bid on that.
Okay.
I think they really would be really reticent to do that, because effectively you're saying the dollar is not the center of the system anymore. Now it's gold. And so I think that anything having to do with gold would be an absolute last resort. But I think doing something like that is possible. I think it's ultimately where this movie's going. But I think it's possible.